Hello, everyone. This is Daryl Hart. Last week's market was nothing short of dramatic. Many investors were caught off guard and left deeply uneasy. If you're feeling anxious or unsure, don't worry. In this video, I'll help you clearly understand the chain of events that led to this situation and share my insights and strategies as a wealth strategist with 25 years of experience. We've just witnessed what I'd call a classic risk reset week. Practically overnight, the market's focus shifted from boundless optimism about artificial intelligence to deep skepticism and renewed concerns about the stability of the traditional financial system. The trigger behind last week's market turmoil was clear. Two important regional banks, Zions Bancorp and Western Alliance Bank, both filed disclosures with the U.S. Securities and Exchange Commission (SEC), revealing serious loan problems. Zions Bank reported that one of its subsidiaries had to write off around $50 million in bad loans. These loans were made to a borrower called Kent Group, which Zions accused of false representation and breach of contract. The bank has already filed a lawsuit, suggesting that this money is likely unrecoverable and will be recorded as a third-quarter loss. Western Alliance Bank faced a similar issue, but on a larger scale, with an exposure of about $100 million. The bank alleged that Kent Group failed to provide sufficient collateral and may have even falsified documents and diverted funds. The market reaction was swift and brutal. Zions stock plunged more than 13% in a single day, Western Alliance fell nearly 11%, and the regional banking ETF KRE sank more than 6%. Panic quickly spread. Even the stocks of major banks like JP Morgan Chase and Bank of America were dragged down, as investors feared this wasn't an isolated incident. JP Morgan CEO Jamie Dimon's famous quote was widely circulated again. When you see one cockroach, there are usually more hiding in the dark. That kind of fear led many investors to adopt a sell first, ask questions later approach. On the surface, tens of millions or even 100 million of bad loans might seem insignificant within the vast U.S. financial system. So why did the market react so strongly? Because this happened at a moment when macro liquidity was already stretched to its limits. This brings us to the second key issue, the Federal Reserve's quantitative tightening, QT, and the drying up of liquidity in the banking system. Think back to March 2023, when Silicon Valley Bank collapsed and the regional banking crisis broke out. It was exactly when banks' reserve balances fell below $3 trillion. The Fed was forced to intervene and inject liquidity to stabilize the system. Now, history seems to be repeating itself. Regional banks are in trouble again, and that's no coincidence. This also explains why Fed Chair Jerome Powell rushed to calm the markets recently, hinting that QT may soon come to an end. So, this credit issue is essentially a stress test of the financial system's fragility under extreme liquidity tightening. A single spark in such a dry environment can easily ignite a wildfire. Meanwhile, the AI sector, led by Nvidia and TSMC, showed surprising resilience last week, even managing to rise at times. This suggests that when investors seek safety, they still cluster around the strongest growth narratives. But that strength may be masking some serious risks. Sharp-eyed analysts have pointed out that many AI companies, including some giants, are heavily reliant on debt to fund their massive capital expenditures. Oracle, for example, carries debt in the hundreds of billions, while Meta is planning a large bond issuance. Even more concerning is what some call the Nvidia shadow company model. Firms issuing debt to buy Nvidia GPUs, then using those GPUs as collateral to borrow more money to buy even more GPUs. This circular model is eerily reminiscent of MicroStrategy's Bitcoin leverage play, and it only works as long as GPU prices keep rising. If the AI boom fades or GPU prices fall, collateral values would shrink, potentially triggering a debt chain crisis. Right now, this kind of loop trading, OpenAI investing in Nvidia, Nvidia investing back in OpenAI, and Oracle cutting massive deals with both, has created a dizzying web of transactions. Whether there's a bubble behind this collaboration frenzy is a question worth asking. The debate over the AI bubble has now shifted from macro narratives to the micro level of financial scrutiny, with Oracle at the center. There's a growing rationale around the true profitability of its AI server rental business. On one hand, the tech outlet The Information published a detailed report estimating wildly different profit margins across GPU models, H100 at 26%, H200 at 19%, AMD GPUs at -8%, and NVIDIA's newest B200 at -220%. After weighting these figures, Oracle's overall profit margin from its AI server rental business would be only about 14%. The report's logic is sound. Early-phase hardware investment often carry heavy depreciation and cost burdens. On the other hand, Oracle's management made a shocking statement in a recent earnings call, claiming that its AI server rental business enjoys profit margins of 35% and predicting that future revenues could surpass Microsoft, reaching $225 billion by 2030, up from roughly $60 billion today. That projection directly contradicts the information's analysis. This sparked intense skepticism in the market. If Oracle is merely a middleman, buying GPUs from Nvidia, which has about a 70% gross margin, and then renting them out to customers, how could it possibly earn 35% profit margins itself? That would imply total margins exceeding 100% across the chain, which defies basic economic logic. Why wouldn't end customers just buy directly from Nvidia? If something seems too good to be true, it probably is. Situation led many to question Oracle's claims and whether the entire AI boom is masking a massive financial bubble. Oracle stock subsequently plunged, dragging down the entire Nvidia shadow company ecosystem. CRWV fell 4.87%, NBIS dropped 9.6%. Even Nvidia's own stock chart flashed warning signs showing a bearish descending flag pattern and breaking below a key upward trend line. Unless it recovers quickly, more downside could follow. This intricate web, OpenAI investing in Nvidia, Nvidia investing in OpenAI, Oracle tying the two together, now looks increasingly fragile under financial scrutiny. When one company projects unattainable long-term revenues and another presents profit margins that defy common sense, investors should be on high alert. The truth will likely emerge in the upcoming earnings season, but it could also be the pin that pops the bubble. What's more worrying is that the weakness in AI stocks and fears over the banking system are now feeding into each other, putting double pressure on the broader market. When both major engines of the market stall simultaneously, the S&P 500's technical chart naturally turns bearish. Right now, the index appears to be forming a classic pattern known as the three-stage decline. This setup usually begins with one large red candle, followed by a few small rebound candles that fail to surpass the first candle's high, and finally another large downward candle breaking below the first candle's low, confirming a downtrend. The index is now testing key resistance, and failure to break higher could complete this bearish formation. Even more concerning, the market may be forming a larger-scale head and shoulders top, a highly reliable reversal pattern. If the index breaks below the neckline at 6,550 points, it could trigger a broader technical sell-off. Market sentiment indicators support this view. The fear index, VIX, surged and then dropped sharply this week with wild daily swings. Historically, such sudden drops in volatility often precede even bigger market storms. Notice something critical. While the S&P 500's pullback from its peak seems small, internal market sentiment is already extremely pessimistic. That means the breadth of the decline is wide. Many individual stocks have fallen far more than the index itself. Beneath the surface, the market's weakness is deeper than it appears. All of this suggests that volatility will spike sharply in the next 2 weeks. Investors need to buckle up. The market is entering a crucial information verification phase. Short-term price moves will be driven heavily by policy and fundamental headlines. To stay on track and not get lost in the turbulence, you must watch the policy signals closely. Last week's V-shaped market rebound, for instance, was largely driven by former President Trump's unexpectedly softer stance on tariffs. But that was just talk for now, and its inconsistency remains the biggest risk. This week, any substantial progress or reversal in U.S.-China trade negotiations will directly affect market sentiment. Are there reports of high-level talks? Is there a clear timeline? Could Trump again post a surprising message on social media? Positive news could give markets a short-term boost, especially in sectors sensitive to trade tensions like tech and shipping. But if talks stall or uncertainty rises, risk aversion will return quickly and crush any rebound. The Fed's meeting and hints about rate cuts are equally critical. As we discussed, the fragility of the banking system is tightly linked to the Fed's QT program. Markets are desperate to see whether the Fed will end QT early or signal a more dovish stance in light of recent risks. Any comments from Fed officials this week, especially about interest rates and balance sheet policy, will move the markets. Even a small hint that they're prioritizing financial stability or slowing liquidity tightening could support stocks, especially bank shares. But if the tone remains hawkish, liquidity concerns could intensify. In such a high-volatility, policy-driven environment, investors' main task isn't to predict which official will sound hawkish or dovish next. That's impossible. but to build a disciplined framework to avoid emotional decision-making. Here's my strategic perspective based on 25 years of experience. This isn't investment advice, but rather a decision-making framework. First, stay calm and avoid emotional trading. Panic is the biggest enemy of investors. While the current situation is worrisome, it's too early to call it another 2008-style crisis. The Fed is aware of the liquidity strain and seems prepared to act, which provides a policy backstop of sorts. Second, stress test your portfolio. As we discussed last week, ask yourself, can my portfolio withstand further market declines? How much exposure do I have to the financial sector, especially regional banks? Are my high-valuation tech stocks fundamentally strong enough to survive potential deleveraging? In this environment, it's wiser to seek undervalued, lower-risk opportunities rather than chase already inflated names with questionable narratives. Third, consider defensive positioning and diversification. When uncertainty rises, adding defensive assets is smart. High-quality treasuries and consumer staples can act as stabilizers. True diversification means balancing across asset classes, not putting all your eggs in one hot basket. Finally, be patient and wait for clear signals. Don't rush to buy the dip, especially in the eye of the storm, like regional bank stocks or overvalued AI plays. Catching a falling knife is dangerous. History shows real market bottoms don't form in a single day. Until signals are clear, caution and risk control are key. The market is transitioning from emotion-driven moves to fundamentals and policy-driven dynamics. Staying alert to these shifts will lead to better decisions. My friends, markets like seasons move in cycles. There's always winter before spring. Every crisis carries both danger and opportunity. For prepared investors, a correction can be the perfect chance to buy quality assets at better prices. Our main task now isn't to predict the worst, but to prepare for all outcomes so that no matter where the market goes, your financial ship can stay steady. I hope this deep dive analysis helps clear the fog and gives you a sharper view of today's market landscape. I'm Daryl Hart. Thanks for watching. If you're feeling uncertain about the current market or found this analysis insightful, please subscribe to my channel and turn on notifications. Every week, I'll bring you in-depth macro insights, actionable wealth strategies, and guidance on asset allocation and risk management. Let's build resilient wealth together, even amid the world's most complex markets.